This session will be on strengthening federalism. Now, this session is being moderated by Professor V.N. Alok, who's from Indian Institute of Public Administration. He is also a member of the Delhi State Finance Commission and has written extensively on India's fiscal federal architecture, and has also previously worked in international organizations such as World Bank and Forum Federations. He developed the concept of devolution index and also advised governments of Brazil, Sudan, and Nepal previously.
I'll move to Dr. Sudipto Mundle, who was the member of the 14 Finance Commissions, and the recommendations of the 14 Finance Commissions are there in place. Before I request Dr. Mundle to make his opening remarks, a minute or two on him. He's now with the National Council of Applied Economic Research, and he has been with the Asian Development Bank and professor at the National Institute of Public Finance and Policy. He has been writing extensively on various aspects, macroeconomics, state subject particularly that's very close to his heart, and various other subjects. So thank you, sir, that you're here with us. Before, sir, you make your opening remark, I just have a question to you. The 14 Finance Commissions made certain path-breaking recommendations, and this government, which is there in place, headed by Narendra Modi, they accepted the recommendations. There could have been a case that the Finance Commission is only a recommendatory body under Article 280 of the Constitution, and under Article 281, it is for the Parliament to decide whether to accept it or not to accept it. So they accepted the recommendations, and that is there in place. Then what made this government to frame such kind of terms of reference for the 15 Finance Commissions, which is not really a verbatim reproductions of Article 280, but of a number of other areas. So I will not request Mr. N.K. Singh to say on this. I know he has limitations. But the central government could have submitted a memorandum instead of making a micromanagement and asking the 15 Finance Commissions to get into this. So this you may like to include, or otherwise you make your opening remarks on this.
First of all, thank you very much, SKOCH, for inviting me to be a panelist today. I should mention that when I was an undergraduate student here in St. Stephen's College, we used to hear about a person who had been a legendary debater, and that was none other than Mr. N.K. Singh, who had already passed out a few years before I got there. So to be on a panel with him and to speak immediately after him, I must say, is quite a daunting challenge. Fortunately, I think on most things, he has made a brilliant presentation, I thought, and I happen to be on the same page as him. So it is not that daunting after all. Let me now come to the subject hand, and perhaps in some way it will address the question Anup you raised. There is a context in which, again, this question of the architecture of fiscal federalism in this country has got a lot of attention, and there have been a few key developments which impinge on this architecture. The first one, of course, is the introduction of the goods and services tax, and which is now supervised and monitored and implemented by the GST Council, which brings about a whole different quality of relationship, because that council is headed by the finance minister, but its members are all the finance ministers of different states. It's made a very big change. Second development was, of course, the abolition of the Planning Commission, and eventually even the removal of the distinction between planned and non-planned finance. This is a subject on which Mr. Singh did speak at some length. But again, this affected the structure of our fiscal federal relationship, because as you will recall, the Planning Commission was at its apex. There was the National Development Council headed by the Prime Minister, which in that old form does not exist anymore. Third, there was the award of the 14th Finance Commission, which Anup was referring to. Since I was a member, I should take a few minutes to explain what it done. There is a certain amount of revenues, what is known as the shareable pool, which is shared between the center and the states. This does not include some items of revenue like cesses and surcharges, but all taxes are included there. Now, progressively from one finance commission to the next, the share of what goes to the states has been incrementally going up. Under the 13th Finance Commission, it had been raised to 32% of the shareable pool. The 14th Finance Commission very substantially raised this to 42%. But I should also emphasize that while the total of the shareable pool that was devolved was raised to 42%, the share of the shareable pool itself was actually not raised at all by the 14th Finance Commission. In fact, at that time, it had been about 61 or 62% during the period of the 13th Finance Commission, and during the 14th Finance Commission, it became something like 63% of the total shareable pool. But as I said, the devolved part, the devolution part, was raised from 32 to 42%. That was a big change. There was a lot of misunderstanding that as if the total amount of the shareable pool that was being given to the states was being raised. Actually, what was raised was just the untied part, the devolution part, because that is just given as a share of taxes to the states and they do what they want with it. But while not raising the total fiscal space of the states, it certainly raised their autonomy, their power to decide what to do with that fiscal space, and in that sense it was indeed a significant change. The next big development, and this again something Anup referred to, were the terms of reference of the 14th Finance Commission, including the amendments, 2 amendments that have come subsequently. Rightly or wrongly, a number of states felt that this was the beginning of an intrusion to reduce the autonomy of the states. And I must emphasize here that Mr. Modi, then as Chief Minister of Gujarat, had been one of the leading proponents of increasing the powers of the states in federal fiscal relations, as in fact is mentioned in SKOCH's sort of background document. Whether his view on this has changed in his new vantage position as Prime Minister or not, I do not know. It can happen because you see things from a different perspective. So that was there, and some of these states felt that their fiscal space was going to be eroded. Some states got together and formed, not an association, but they had some seminars and so forth. So that has also created some concern, and also the amendments that followed. So this is the context in which we are today again talking about federal fiscal relations. Let me start by making first of all, in passing, I don't know whether I'll have time to come back to it, that when we talk about federal fiscal relations, there are actually 2 parts to it. There's a relation between the center and the states, which gets most of the attention, but there's also the relationship between the state governments and the third tier of government, namely the Panchayati Raj institutions and urban local bodies. And this very often is largely neglected. If I have time, I'll come back to it, but let me put that aside for the moment and talk mainly about the relation with center and states. Now, what that amendment suggested, the first amendment, was to carve out something from the devolution share, for defense and security purposes. And it was seen as this was taking away fiscal space of the states. Now, while defense is a national subject indeed in terms of the distribution of subjects in Schedule 7 that Mr. Singh was referring to, internal security is certainly partly a responsibility of the states. And in that sense, a part of what is their fiscal space has always been and continues to be devoted to internal security. Now, so if a part of this is replaced by the center taking that over, maybe the fiscal space is not reduced, only the autonomy is being reduced in the sense that now the center decides how, say, the state police and so on are to be assigned as part of their tasks are to be assigned as a central decision rather than that of the states. But the fiscal space which was being used earlier for this purpose will still be used for that purpose. And that's just a little clarification I wanted to make. And it's important to make this point because this, in a sense, the same thing applies to the centrally sponsored schemes to which Mr. Singh referred at great length and described extremely well what this does. Since these are tied, shared responsibilities, the center gives some money, the states give the rest. So being part of that means it also ties up a part of the fiscal space of the states for programs which are actually decided by the center, and there's a huge proliferation of them. They are in fact a major source of fiscal transfers apart from Finance Commission awards, and this has become a very contentious issue. So with these thoughts in the background, there are different options of how to restructure federal fiscal relations which have been talked about, and I will quickly go over them. The first one, and which is something that a number of states have been saying for quite some time, and that has to do with the fact that, look, whatever it is that you decide to give us, whether it is 40% or 50% or 62% as is the case, give us the whole amount as a devolution, and then let us decide what we will do with it. You don't tell us how much of it is to be used for some other purposes. Now, I think this is an unrealistic demand of the states for the simple reason that there are a number of things that the states deal with which have spillover effects beyond the borders of the state. Whether it is you talk about health or even education and so on, a number of these things, certainly environment protection issues, pollution issues. So therefore, they cannot just be left to the states, and they have to be also addressed by the center. A second aspect, which is often forgotten, is that while the states may be demanding that it be left to them to design their own schemes and policies and so forth, and they just be given a total amount as untied amount, this may be fine for the more advanced, better off, high capability states, because they can indeed design their own programs and so on. But there are weaker states. I don't want to identify them, but you know that there are a lot of these states which are sort of lower down in the ordering of the advancement of states and their capabilities, who are actually not in a position always to design these programs. And they often say that it helps us if there's a centrally sponsored scheme under which there's a central design which comes to us. So there are two sides of that argument. Second option, which has also been proposed, is that even though the Planning Commission was abolished, there are certain tasks of planning which remain, and therefore we now have a missing institution, and different suggestions have been made of how this can be changed. One suggestion is that I don't know what Mr. Singh will think about this, but one suggestion is that the Finance Commission be made into a permanent body, which was never made, even though it's a constitutional body, and a body which is not actual constitutional body, like the Planning Commission was a permanent body. So that was an anomaly which has now been partially corrected. You can go a step further, make the Finance Commission a permanent body, and since there are no distinctions now between plan and non-plan subjects, and the Finance Commission looks after the total finances and the allocation, it can also look beyond short-term allocations to long-term allocation for planning purposes. So that would be another way to go about it. But this would mean actually a further erosion of the autonomy of the states, because right now what is being decided with the states would then be decided by the Finance Commission. And while the Finance Commission is not a body of the central government, it is a federal body which is, as it were, a referee between the center and the states. It is nevertheless a decision which is not the states. So this would be a decision-making power which would move away from the states, so it would obviously not be very popular with them. But there's a third option, and that is my preferred option, which is to empower a body that already exists, that is the Interstates Council. Now, this is a constitutional body that exists. Unfortunately, it has never been used properly. It is parked inside the Home Ministry, which is very peculiar for a Home Ministry central government, which is a very peculiar thing to do for what is supposed to be a federal body. But that can be reinvented, can be restructured as a genuinely powerful body, more or less modeled along the lines of the GST Council, except that in this case, the chair would be the Prime Minister, not the Finance Minister, and you would have the Chief Ministers as members. And they would be making decisions on things like programs that are currently being supported by these centrally sponsored schemes and so on, which Mr. Singh talked about at great length. And given the experience that we've had with the GST Council, it is certainly the most effective federal institution of cooperative federalism that we've had so far. I think that's a good model to think about. And let me say in passing, and in fact endorse what Mr. Singh already said, that the GST, the way it has been rolled out, is one of the main reasons why there's a huge shortfall in revenues today, and that is causing a lot of stress in our macroeconomic management and partly responsible for the decline in growth rates and so forth, which I'm not going into now. But it is important to recognize that it is only because it was rolled out without proper preparation, in fact of the GSTN and so on, which is at the core of it. But this should not be taken as implying that the tax itself is something that is not good. In fact, it's an excellent tax, and I hope we will quickly get our act together to reform the way that tax is being administered. And let me stop there. Thank you.
I can request Dr. Puja Mehra. She has been introduced in the first session. She was moderating there. She has been writing very extensively in newspapers. She has been awarded for her journalism in economics and finances. And you can take up the suggestions made by Professor Sudipto Mundle that can this Niti Aayog too can assume the role of the earlier planning commissions. And so can that be?
Thank you very much. Am I audible? I think the point has been made by Professor Mundle, before him, Mr. Singh, and many other experts before, that whereas the Planning Commission was, for long, it was said that it had not kept in tune with the needs of the economy, and after 1991, it was struggling to define a role for itself. But at the same time, the abolition of the Planning Commission and its replacement by the Niti Aayog has sort of created a vacuum in terms of the states not having any platform for dialogue with the center in terms of their annual plans, in terms of negotiating for funds and bargaining for schemes to eliminate or reduce regional imbalances, because the finance ministry is not very equipped to perform that sort of a role. The finance ministry's primary focus at all points in time is revenue collection and fiscal deficit, and that by its very nature kind of conflicts with states wanting more funds or funds in a certain way for spending, for development expenditure, etc. So I absolutely agree that after the Planning Commission was abolished, there is a vacuum, and the states need some sort of platform in the center to talk about these things to the center. The more immediate issue, I think, in fiscal federalism that we are facing already and will face is on the GST. Already collections are falling short of the 14% growth year on year that was, I think, promised, projected. And states are wanting an extension of the assured compensation from the center for shortfalls in what they projected as collections. And in fact, some of the compensation that has to be paid to them, state finance ministers have come to Delhi last week and complained that those are pending. They are not getting their dues. Now, why has GST turned out to be the way it has? I think the political economy of it is responsible over here. The mechanism of the GST Council, which is the main institution that that is common platform on which the center and the states talk to each other on these issues, comprises of state finance ministers, and state finance ministers stand to lose bulk of their clout. Now this is a political economy issue. They stand to lose bulk of their clout if the GST becomes very smooth, because that would mean no discretion for state finance ministers. That would mean nobody would come to them and lobby for changes in tax cuts, removal or addition to exemption lists. And state finance ministers' job would not be as high profile as it is right now. So I think what is happening is that at the GST Council, there are these bunch of politicians, all of who want, whether they realize it or not, but if they have to perpetuate their clout, they have to perpetuate discretion, and they have to perpetuate complications, and that's not what the rest of the economy wants. So perhaps it is time for us to begin to question if we need a different institutional setup in place of the GST Council, and also how prudent it is to keep revisiting the tax structure, the compliance structure, and if less political inputs and more of technical inputs begin to go into these decisions. Finally, I wanted to make a small point on the uses of cesses by the central government, which is another sticking point between the center and the states. All the cesses that the center collects, they don't share that money with the states. They get to keep all of it. And I think at the last calculation, the center's collecting almost 14% of its gross taxes as cesses, which I think is very unfair to states. And that is probably another point that needs to be discussed.
Professor Renu Kohli, professor at the National Council of Applied Economic Research.
Yes, I think I endorse and agree with Mr. Mundle and with Puja about the need for a platform for extensive, more, greater camaraderie and more franker and longer discussions with the states. I also want to flag a couple of things that Sudipto mentioned, which was, one was about the permanent demand for or a suggestion for a permanent finance commission. In my view, it would not be, as he also disagreed, and I would also strongly argue against such a permanent body. For a couple of reasons. One is that inherently by composition, design and structure, the Finance Commission is weighted and primarily decided by the center, A. And second is that reason that the states in any case have an inherently weak position to start with in terms of their dependency, or even though the process is very extensively consultative and their concerns are taken on board, but they have a resource, they have a financing constraint which the center does not have, which is that the center can pretty much borrow and resort to deficit financing. It's not that the states can't, they can do so too, but they must take the permission of the center. Usually that permission is always given and it doesn't really, constrain the states, but the fact that it has to be, the permission has to be taken is by itself a kind of a weakening premise. More than that, I think the most important point is between the center and states fiscal relations and consultation is when the going is good, that means that if there is a cycle is on the upswing, the revenue position is buoyant, things are good, and therefore there's enough money to go around. But the problems arise and the strains arise on the downswing when the cycle is going down, and currently we are facing that, and it's a vicious spiral. It's a vicious spiral because revenues go down. On one hand, there is this, very optimistic promise of 14% nominal growth in GST revenues. Furthermore, both the center and the states are constrained by the fiscal rules, which is the Fiscal Responsibility and Budgetary Management Act, and that binds that the general government debt to GDP ratio has to be brought down to 60% by 25. And on the other hand, the reduction in the case of the states has to come down to 20%. Currently, it's almost 25% of GDP. In the case of the center, it has to come to 40%, and currently it's in the region of around 48% of GDP region. Now, what is happening is that the vicious spiral growth goes down, revenues go down, and the center has a greater tug in terms of its commitment to the states, but then the states are bound too, because all these assumptions have been made on the basis of nominal GDP growth of 12% of GDP. And I was just looking at the numbers put out by the RBI in its report on state finances on debt sustainability. And already the RBI is projecting 11.5 average for the next 5 years. So the constraint is going to be very, very biting and binding for the states who have already been cutting down capital spending. How do you get out of this trap? The only way to me, it seems, is the FRBM itself ought to be amended, which means that coming back, both center and states coming back to the table. Thank you.
Thank you, Professor Kohli. Ladies and gentlemen, we do have an economist who has worked in the Reserve Bank of India, and I call him a banker. At present, he's with the Anderson School of Management at the University of California, where he visits quite often. So, Professor Singh, generally the poor and the rich states, they are in conflict with each other for the fiscal transfers of resources. Some says that it could be on equity considerations, the rich state says is on efficiency considerations. But you being a banker, the rich states generally get a very favorable treatment from the scheduled commercial bank. The poor states, the credit deposit ratio is very, very low because of the economic development, the pattern of economic development that they have. Is their economy is based on agriculture, small scale. So there is a capital flight that we have seen. So how do you really see this part of this?
Now, before I come to the pointed question that you are asking, I would like to make a few points. Actually, I would like to make two major points for the Finance Commission. And then from there, I'll relate to the banking industry. If you look at the data, and this issue has not been touched at all in most of the cases. If you look at the data for the Finance Commission, and we are into the 15th Finance Commission, at the state level, the Finance Commissions have not been so regular. And if you look at the local bodies, the situation is extremely difficult. So therefore, I feel when there is a story of the Finance Commission, and as Professor Mundle was mentioning, that we need a permanent Finance Commission, I thought it was very pertinent to mention that though at the federal level, we are doing, and this is a session on fiscal federalism, though at the federal level we are so strong and we are doing so much onto the fiscal front, it's not replicated at the state levels and certainly not at the local bodies level. Now let me also bring to your notice, when you look at the local bodies, there is not even a consolidated local body data in our country, even for Karnataka, a state which is pretty advanced, and World Bank is helping them to put in a place a data statistical place where we would have a consolidated picture of the local finances. So I think that is one thing which I wanted, that we need to strengthen while we keep doing the intergovernmental transfers and we talk of the centrally sponsored schemes. Is it that after nearly 2.5 decades of the 73rd amendment, our local bodies are still not strong and they're dependent on the transfers which come from the Finance Commission at the center. The second issue that I wanted to flag was basically the interest rate burden on some of the states. Now you will be surprised to know that in states like Haryana and Punjab, nearly 20% of the revenue receipt or nearly 19% of the revenue expenditure goes on interest payments. Now if this was the situation in the private corporate sector, they would have gone for debt restructuring. But here in the state finances, that's why I say, as for the center, the Finance Commission regularly looks into various issues. For the state governments, I think something needs to be done there. The last point that I want to make on the fiscal issue before I come to the banking sector, yes, the resources that are available at the local bodies are limited, and that's understood. I was thinking, like the state governments followed a joint family approach while borrowing, and my colleague here, Renu Kohli, Dr. Renu Kohli would know how in the Reserve Bank we used to follow the joint family approach for market borrowings. Maybe for local bodies, whosoever are willing, we should adopt the same strategy and help them borrow. Now coming to the pointed questions that you mentioned, as far as the banking is concerned, I would like to say that if you look at the highest deposits and the highest credit numbers in crore, you are right. The western region is at the top, and Maharashtra and Gujarat are the highest in deposits, very prosperous states, very rich states, followed by southern region, Karnataka and Tamil Nadu, again as expected, followed by northern region, Haryana and Punjab, even Delhi. Delhi does much better than Punjab. When you look at the deposits, this is the picture. When you look at credit, because you spoke about the credit deposit ratio, when you look at credit, surprisingly, the western region again tops. So and again Gujarat and Maharashtra on the top. The southern region again is number 2, Tamil Nadu and Karnataka. Northern region is number 3, again Punjab and Haryana. To that extent, the credit deposit ratio gets evened out. Now when you look at the latest trend that is happening, look at the growth rates and compare the credit growth with the deposit growth, you'll be surprised that credit growth is higher because of the absorption capacity, the way industry comes up in northern, western and southern region. In the deposit over credit, deposit growth higher than the credit, where now the issue of the CD ratio not coming up to the expectation, or the term that you use, the flight of capital, is very true for northeast, eastern and central region. So to some areas, the hypothesis of yours is applicable, while in other areas, like the northern, western and southern, CD ratio almost balances out. I would like to conclude this opening remarks of the questions that you raised by saying, yes, obviously, states which do not have high absorption capacity are those states where the high per capita income is not there, and therefore they are not able to generate or create deposits equivalent to what their requirements are. And that is exactly the reason that then the government intervenes and brings in the issue of the priority sector lending. So there's more equitable distribution, at least of credit, if not growth. Thank you.
Thank you. Thank you. Good that you raised the questions of the local government, both panchayats and municipalities. These two institutions are actually mandated for the local service delivery. And you also raised the issues of strengthening the State Finance Commission. We'll come back to this. And before that, we can take one or two questions from the participants. If there are any questions, yes, There's a gentleman there. Can you give a mic, please?
Good afternoon, sir. So, taking off from what Charan Singh sir said, I wanted to ask Professor Mundle about the local bodies. There was an analysis done a couple of years back in an economic survey by Arvind Subramaniam, and he had said pertaining to urban local bodies, he had analyzed 14 states, and he said there's one aspect of the transfer from the state to the urban local bodies. But there's another aspect of urban local bodies having the capacity to collect taxes. And according to him, there was only there were about 14 states that he had analyzed. I still remember the number. He had said that they're collecting only 7 to 19% of the taxes which they can collect. So the tax collection capacity right now is also very less amongst the urban local bodies. So when it comes to fiscal federalism, there's one aspect from center to state. But won't it truly be fiscal federalism in your view when urban local bodies and panchayati raj bodies are empowered for revenue generation and expenditure at the local level?
Okay, thank you. Anybody else? Okay, so the question here is that there is a tendency of centralizations of revenue and decentralization of responsibilities. The institution down the line, that is municipalities and panchayat. Municipalities, we can exclude municipal corporations, so they can collect revenues. For example, Bombay Municipal Corporations or the NDMC, New Delhi Municipal Councils. But if you leave municipal corporation, the municipalities and Nagar Panchayat are as good as the Panchayati Raj institutions. So they collect very little revenues of their own. Sir, would say so.
I'm very glad you on. Can you hear me? I'm very glad you raised this question because it gives me a chance to address something I wanted to say during my original talk, but I had run out of time. You know, there's an impression that after the 73rd and 74th constitutional amendments, that the local governments like Panchayati Raj institution on one side and urban local body on the other have been very substantially empowered. But the fact of the matter is that both those amendments actually left it to the state governments to decide how much should be really devolved in terms of empowerment to the local bodies. Now, the state governments are governments where legislation is done by the MLAs. And so it's a zero-sum game. The more you devolve to the local governments, the less is left for the MLAs. So in other words, the very people who would find it against their interest to devolve to the local governments were empowered to bring in the legislation would enable that empowerment. So there's a kind of contradiction in that amendment itself, and what you have seen, the complete failure of local government capacity to develop, which Mr. Singh was referring to, is really a product of that. And as a consequence, the state finance commissions are not taken very seriously. Some of them are not even appointed. This is a violation of the constitution, but this goes on and we have been living with this. As far as the capacity question is concerned, it's a chicken and egg. You don't invest in them, you don't allow capacity to develop, and that then becomes a judgment, oh, they don't have capacity, so we cannot devolve further. So you really have to crack the problem at the level of initially legislatively, constitutionally empowering them, and then you can take the other steps.
Some of the local bodies like the Baroda Municipal Corporation, Ahmedabad Municipal Corporation, Mumbai Municipal Corporation, which are doing reasonably well. And at least such corporations, if one can conceive an umbrella body which can help them raise resources so that they're not constrained in their expenditure by the revenues that they are able to muster, whatever, or the transfers that happen to them from the state or the center. At least such local bodies which have some credibility and have done some borrowing in the past, they could be brought together. So that was the thought when I spoke about the joint family approach for borrowings by the local bodies, so that they can spend more, they're closer to the masses and their expenditure is more effective, easily evaluated and easily monitored.
Thank you. Any other questions this side? Okay. This municipal corporations, Professor Singh, is almost like a state government there in Bombay, and they had a very buoyant source of revenue. For example, octroi, that is there with them, and which has been now converted to a local body tax, and as controversial as octroi was. But the question was, Professor Mundle has said, is about these panchayats. They hardly collects any revenues of their own, hardly 5%, and depends upon the intergovernmental transfer systems. His commission, that is the 14th Finance Commission, allocated 2 lakhs crores over a period of 5 years, and said that interstate distributions for this money among all ranks of panchayat within the state has to be with the recommendations of the state finance commissions. But that did not really help to the state finance commission to come up. So how do we strengthen the state finance commissions? Because this institution is there for the last 25 years or so. The act of the State Finance Commission is not very similar to the act of the Union Finance Commissions. The constitutional provisions, that is Article 243I, it says that at the expiry of every 5th year, it didn't say the expiry of every 5th year or earlier, what is the case of the Union Finance Commission. So the state government, they can constitute a commission, or they may not constitute a commissions. And if the report is submitted, that is the case there in Maharashtra and Karnataka in the past, did not really see the light of the day. Okay. So my submissions, if you all agree, is as follows. On the line of the Commonwealth Grant Commissions, because there in Australia also you have the Commonwealth Grant Commission, very similar to the Finance Commissions, and at the state level, the State Grants Commissions. So Commonwealth Grant Commissions allocated certain percentage to the states, that if you constitute the State Grants Commission, then you will be eligible to get this kind of money. So that actually helped there in Australia to constitute the State Grants Commissions. I think the similar, I don't know, Professor N.K. Singh has just gone, the 15 Finance Commissions can suggest for the states that the State Finance Commissions come up with this. So this is about, any other questions or any comments to make at this point? Yes, the lady there.
My question is not on if we have to cut down on CSS, it's majorly how when center contributes to the matters which are on the subject list, do you reckon that states should also contribute to the subjects which are specific to the center, like let's say defense or security, internal security?
On the CSS issue, whether it's a problem in implementations, well, I would say yes and no. Many of these schemes actually require that the center are bound by the kind of a matching contribution, which is probably the ratio in 60/40 and so on. Now, the real issue is actually, which was touched upon by Mr. Singh and by Mr. Mundle also, that what is the constitutional position in terms of the list 1 and list 2 and list 3, which is, exclusive domain of the center, exclusive domain of the states. Now, as far as the center is concerned, and there was also an additional question on national security and defense, so I may also include my answer to that, which is whether states should contribute. No, it is the responsibility of the center, and the center's responsibilities are very, I would say it's a very bad idea. It's just an, underhand way of dipping into the state's share. So going back to the CSS. Now, the problem is like this. If you look, let's just take the period from 2011 to now. If you see, overall expenditure on education and health, is about 4.5% of GDP, of which 4.1% comes from the states. Capital as well as revenue on expenditure on health and education. If you see the center's contributions or spending on in the education sector, it has actually halved from what it was in pre-2014 to now. It's barely down to 0.1% of GDP. And the general increment that has taken place, the states have kept up. Ditto for the health sector. Now, many of these schemes are relating to, obviously, you know, education, health, primary, etc. So, yes, I mean, I think there is an issue there. And the states should have the greater play because they also have a greater capacity and capability to spend.
I think you all agree with this that the terms of reference or the period of the finance commissions can be revisited. If you all agree with this, I think there could be one consensus from this house. Right? The finance commission terms is 5 years. Now, you also have a GST council there in place. So, the other commissions in the world, they generally permanent body or they are there for longish period. So why this finance commissions for 5 years or so, why can't be 10 years? This is what Dr. N.K. Singh just proposed there. So Mr. Kochhar wanted this, there has to be one or two consensus from these discussions. So if all agree, that's right. I do have another proposals, if you all agree. See, Finance Commission is a federal body, and it's a terms of reference and the membership are all decided by the union government. I met some friends there in Kerala and other places. They said there has to be a meeting of state finance ministers to decide the terms of reference and the membership. For example, the membership of the Commonwealth Grant Commission, the Fiscal Financial Commissions, there are some representations from the local government associations. So this particular job should not be left to the North Block. The whole consensus be there in place. So if you all agree with this. So thank you so very much for the participation. This was a very excellent session. A lot of suggestions has come. So thank you so very much, and thanks Amit for this. Thank you.